Welcome back to Growing Quality. My name is Elian, and well, PayPal just can't seem to go up. It just keeps bobbing around that $60 mark. It's becoming annoying, but I think there's an end coming to it. And I become more and more bullish the more news I see regarding the company. Now, if we look at the performance for the year-to-date return, we can see that it's down. Well, it's basically flat. We can call this flat. Minus 0.59%. I call that flat. The 1-year return is minus 15%, and the 3-year return is a horrendous minus 79%. On a 5-year basis, the stock is down, well, basically 50%, at, 49%. And when we compare it to the S&P 500, it's just a major underperformer. Now, like I already said, I think this company will go up from here and will go and find some momentum in the coming earnings reports, the coming few over the coming quarters. And let's just see what the issue is that the stock is having in the latest quarter or the latest few months and see why I think this is about to change. So the first time the stock went under $60 was actually in May of last year. Now, after it went under $60, it rallied back to $75, as we can see in this graph here. And right now it's right around $60. And if we look at the weekly chart, this just paints a really painful picture. We can see that the stock is coming down from almost $300, over $300, to, well, just having a incredibly long and slow bottoming out phase. The stock is simply going nowhere. Now, recently, I thought this would change. There was an event, a conference, and the new CEO, or new, he's been there since last September, so it's not that new anymore. But Alex Chris was participating in that conference. And I wasn't the only one that was bullish, because after that conference, the stock rallied like 7% in a day. I made a video about it, and in that video, I became so bullish that I made the statement that I didn't think PayPal would go under $60 again. Now, clearly I was wrong, because we have been under it for the last 1 or 2, maybe even 3 weeks. And, well, I gotta say, there were things that contributed to it. And, well, the first one being the following conference, because the first one with Alex Chris was on June 5th. And on June 11th, there was another technology conference with the CFO. And, well, she just didn't sound as confident, as determined as Alex Chris did. She was giving a lot of credit to others, but wasn't so, well, fueled and fired up, it sounded. Now, that was the first thing that happened. And then we also had the Apple event. And the Apple tap to cash function is, well, or was perceived as the thing that was gonna bring PayPal down. I mean, after the Apple event, the stock basically crashed from $67 back under $60. So about a 15% change, just because now with iPhones you could share a bill. Basically nothing that was that innovative or that big of change, but somehow it was meant to take out Venmo, or perceived as going to take out Venmo. Now, in my opinion, that is absolutely not going to happen, but my opinion doesn't matter here. It's about what the market thinks and what analysts think. Okay, but then it's fine that I'm saying that I think things are going to change for PayPal, and that I think they will get better. The stock price will go up. It will get momentum once again. But then it's up to me to explain why I think so. And basically, it's quite easy, because if we look here, we see the earnings that are coming up. PayPal is reporting earnings on July 30th or 31st. And what analysts are expecting is 98 cents of EPS. They are also expecting $7.81 billion in revenues, but mostly the EPS number is what I'm focused on, because I think they will beat it. Now, if we look here, we see the old way of estimating EPS. So it's gonna take a lot of trickery to find out what it compares to with the new methodology of reporting EPS numbers for PayPal. Because since last quarter, they are taking stock-based compensation as an expense in the non-GAAP EPS number, something not a lot of companies do, but PayPal sees it as more justified because they say that it's what analysts want and how they calculate. So it's more accountability for them and something they will just have to focus on in order to improve the business. Now, that's something I very much like, of course, but it does make it a bit tougher to compare how the numbers are looking now compared to previously. But I think PayPal will beat that 98-cent number. And the reason I think so was this. The technology conference with Alex Chris, in which he bluntly said that at that point in the quarter, they were slightly ahead of the expected numbers. He simply said it. It was halfway through the quarter, and he said, at this point, we are, slightly ahead of projections for their EPS guidance, or their numbers. So, I don't know why they shouldn't beat it. I don't think we have had data that would suggest that the consumer has absolutely crashed and stopped spending at all costs. I think they are not fine. They're obviously not fine. However, they aren't taking a step back from where they were. Now, there are two more things that I think will contribute to their numbers outperforming or beating guidance. Now, the first one is for this quarter and the upcoming quarter already. And the next one is for the next 2 years, 3 years, which will start contributing to the EPS numbers of PayPal. Now, the first thing is Fastlane. And Fastlane has been described, as Alex Chris said in that conference, that it is one of the best things to improve conversion for commerce. He said that from a middle-sized airliner, he got comments that they have never seen a single thing improve conversion like Fastlane did. And it's very easy to see why, because if you have a Fastlane account, it's a separate account. It's not a PayPal account which just will go with Fastlane. You have to make a separate account. But when you go through guest checkout, you don't have to give all your information to another third party. Fastlane has it. They will fill it out for you. And that way you don't have to make accounts everywhere. You don't have to go and look what your credit card numbers are. And then the second thing that I already told you about is the ad platform. Now, the ad platform, they really attracted some talent for it. And I think it will do great. Now, PayPal is going to take a quite unique approach to this ads business because they want to be paid based on the conversions coming through their platform. They don't want to be incentivized by clicks, but by conversions. And this is really important because this also makes it really attractive to advertise on the platform that they are building. Now, they attracted some great talent for it, and I think this can be huge because, ads have really good margins. Just look at Google or Amazon, for example. They do have really good margins. And I think that it's supposed to, or it will help with stabilizing the margins for the business. They already said they are not going to give more pricing for the non-branded or unbranded checkout. So that's mostly Braintree, because they have added so much value that it's now, basically up to the customer to accept the fact that PayPal is going to say, we are going to keep margins here and, just deal with it. We're not going to give any more pricing. And that's another point I think that will contribute a lot. So then, why do I think this is such a safe bet and such a good opportunity in the markets? Well, let's just look at this, because here we see Q3 22 up to Q1 24 and the current numbers. So the current ratios, but also the total common shares outstanding. So we can see that PayPal has done a lot of buybacks. And that's good. That's one of the bull arguments of the stock. But we can also see the price to earnings ratio. This has come down from a 43 in Q3 22 to basically a 15.55 now, or a 16.86 at the Q1 earnings. We see the price to sales ratio at an all-time low. We see the price to cash flow ratio. Well, that's not here, unfortunately, but that's also really, really low. We see the price to book ratio extremely low. Basically, all the ratios are pointing to a very cheap stock. Now, there are always reasons why a stock is cheap. And for PayPal, there is as well. So we will look more closely at why or what these are and why this is. But just know this stock has an incredible margin of safety, because with a average PE for the S&P 500 of well over 20, I think we are right now around at 22 or 24. That means that this stock is just very cheap compared to the markets, and therefore, well, with the discount, either perceived as way less good of a business, or maybe there are some perceived risk or uncertainty. But before looking at the numbers as to why I think the stock has sold down over time as much as it did, let's just look at this, because here we can see the mix across PayPal's payment platform. And what this means is that here we can see that PayPal branded checkout, it grew 7% year over year at the end of Q1 24. We can also see that it was accountable or responsible for 27% of total revenues. We see that the unbranded card processing, so unbranded checkout, which is mainly Braintree, was good for 26% growth and 37% of the total revenues. Now, the unbranded checkout was where they have been giving up a lot of margins. And if we look at the free cash flow, we can see that this, it says it grew a lot. But why? Well, first off, when we dive into the numbers, here we have the active accounts. I use Quadrant for this because I think they have really easy to understand graphs. Now, we can see that the active accounts, the number of active accounts is basically flat. There is no growth whatsoever. Better yet, it's been going down. Ever since 2022, I think Q4 2022, it has been going down. Only last quarter, they finally had a slight tick up, but it was still down year over year. It was only up quarter over quarter. When we look at the transactions per active account, however, this gives a slightly different view, because the transactions per active account have been increasing quite well. Over the last year by 13%, and over the last 5 years, the average is 10%, not even. So the transactions per active account have been going up. They have been increasing, just like the revenues have been increasing. Just not really, really quick. At a 10% over the last year and 13% over the last 5 years, revenue just isn't going up very quickly. But that doesn't matter. PayPal can be a mature business in which revenues grew 10 to 12% per year. That's totally fine, but just be stable and grow. And that's where we see some issues, because if we look at free cash flow for PayPal, we can see that, the number at the bottom says 76% growth over the last year. But prior to this, it's been basically flat. If we look at, take a number Q2 2020 or Q1 2020, for example, it's been flat ever since. There is no growth in free cash flow for the last year. So Alex Chris will have to prove that he can efficiently grow free cash flow for this business. And then we also have the net income. The net income has been flat as well. We see Q2 2020, it spiked all of a sudden, and this is very easy to explain because this was COVID. We can see it just Q1 2020, it dropped to an absolute bottom because the first lockdowns hit. And then the buying spree started. But ever since then, it's been going nowhere. The business has seen no growth in revenues Or well, it has in revenues, but not in net income. Also, EPS has been lagging. There is very little growth in the EPS numbers. And this is what has been frustrating investors. The growth just isn't there at the bottom line. And this has to be improved. Now, if we look at the guidance, because that's the next thing, the guidance, what are they going to expect for Q2? Because I think they will beat this. They expect revenue growth of approximately 6.5% to 7%, or 6.5% at spot and 7% at FX neutral, so currency neutral basis. They expect non-GAAP EPS of 87 cents, and this is with the new methodology. Now, for the full year, PayPal expects free cash flow of approximately $5 billion. And why is this important? Well, because they say they are going to do at least $5 billion worth of buybacks of the stock. Now, that's what every investor wants to see, right? They have GAAP EPS of approximately $3.65, but like they said during the conference with Alex Chris, for the Q2 numbers, they are already slightly ahead, and the Q1 numbers, well, we saw it. That was a very large beat. And if we look at the analyst expectations for the current quarter, we can see that the average estimate is at 98 cents. So analysts are expecting, well, quite a bit more than PayPal does. However, the question here remains, this is mixed between old methodology and new methodology, because also for the current year average estimate of EPS at $4.24, this used to be over $5 because it excluded SBC. It excluded stock-based compensation. And if you don't count stock-based compensation, non-GAAP EPS would be over $5. This is also what PayPal projected. But including stock-based compensation, they say $3.65. And analysts they are switching around for it. They are adjusting it. Now, $4.24 is what analysts are expecting for this year. But I think Fastlane will start making an impact during, possibly Q2 already slightly, Q3 a bit more, and Q4 is where they want to roll it out. So do you agree with me that PayPal is one of the safest stocks in the market with a very large margin of safety? Because how much more will it drop than below a 15 PE and even an 11 forward PE? Or do you completely disagree with me and I'm missing a lot of risks here for the business? Let me know in the comments down below. And if you have liked this video, please give it a like and subscribe to my channel. It helps me a lot. And well, I hope to see you in my next video.